Good morning, ladies and gentlemen. Thank you for joining us this morning. I'm Manwa from CMT Investor Relations. The manager of CMT and CCT have released the announcements on the date of the respective unit holders' meetings and electronic dispatch of the CMT circular and CCT scheme document this morning before market opened. To those of you who have joined us on the live webcast, good morning and a warm welcome. We will kick off this morning's briefing with a joint presentation by the CEOs, Mr. Tony Tan of CMT and Mr. Kevin Chi of CCT, on the proposed merger of CMT and CCT. We will end this morning's session with a Q&A. Without further ado, may I invite Mr. Tan to kick off the presentation. Mr. Tan, please.
Thank you, Marwa. Greetings and good morning, everyone. The proposed merger is a proactive response to the changing Singapore real estate landscape. We first announced the proposed merger in January this year. Today, the merger rationale remains valid and has been reinforced by the impact of COVID-19. Prior to the global pandemic, the overarching trends towards decentralization, mixed-use precincts, and integrated development had already been set in motion by the URA Master Plan 2019. This trend is expected to accelerate now as people demand a shift towards more flexible work arrangements, place higher emphasis on health and well-being. So by coming together to form a larger and more diversified REIT, we are confident the merged entity will be in a better position to capitalize on evolving trends in the post-COVID world and to withstand challenges. Each CCT unit holder will receive 0.72 CMT units plus 25.9 cents in cash for each CCT units. Recognizing the unprecedented circumstances presented by COVID-19, CMT manager has voluntarily waived, on a one-time basis, 100% of the acquisition fee, amounting to approximately 111.2 million, to reinforce its commitment to the merger. And as before, both sets of unit holders will continue to receive permitted distribution until the effective date of the merger. The merged entity will be named CapitaLand Integrated Commercial Trust, or in short, CICT. CICT will be one of the largest REITs in Asia Pacific and the largest proxy for Singapore's commercial real estate market, underpinned by leadership, resilience, and growth. We will be in a strong position to drive value creation for our unit holders. The merged entity will have a greater capacity to unlock synergies and emerge stronger to capitalize on post-COVID-19 recovery growth. And CICT's portfolio will also be more balanced across integrated developments, retail and office asset class, offering a greater stability through cycles. We would like to take this opportunity to provide an assessment of the impact of COVID-19 on the Singapore office and retail landscape. We believe that Singapore office and retail real estate are still relevant and essential. Unique to Singapore, shopping malls remain a key thread in the fabric of society and are well integrated into the daily activities of the population. The shopping mall culture is expected to be an integral part of everyday life and remain deeply entrenched in Singapore. Further, the overarching decentralization theme, which was already in play before COVID-19, will be even more relevant now, so as to promote work, live, play lifestyle in identified growth clusters. While suburban malls have gradually caught up with the reopening in phase 2, as more workers return to office and more shoppers visit downtown malls over the weekend. So while we recognize that office sector is evolving, Singapore office is here to stay. Being one of the key economic hubs in Asia, the CBD will be at the heart of future of office. given its central concentration of quality of its stock and a well-established business ecosystem. The purpose of workspace to meet organizational goals such as productivity, collaboration, culture has not changed. So what is evolving our workspace solution? And this solution may include hub and spoke, core and flex, work from home, or work near home arrangements that are driven by a conscious need for social distancing, health and safety and wellness. The need to accommodate all these considerations in a controlled environment will ensure the relevance of the office workspace. So in order to stay competitive in the light of the evolving Singapore office landscape, proactive management is critical to provide differentiation in services, amenities, technologies, offerings to create a positive impact on the lifestyle of occupiers beyond the workplace environment and in a more sustainable, vibrant, and lively community. So economic activities in Singapore are showing signs of gradual resumption. Although COVID-19 has disrupted our lifestyles, the underlying consumer needs and wants are the same. People still desire to socialize, dine out, and collaborate in a controlled and safe environment. There have been positive signs of recovery in shopper traffic. So for instance, larger and dominant malls such as IMM Building, Plaza Singapura, or the Atrium at Orchard have led the recovery in shopper traffic with 82% and 73% respectively compared to pre-COVID-19 level. Overall, shopper traffic has improved significantly post-circuit breaker, recovering to about 58% of pre-COVID-19 levels. For office, it's important to note that telecommuting remains the default mode of work for companies under Phase 2, as advised by the Singapore government. Nonetheless, since the beginning of phase reopening, there's an increasing trend of returning employees. So what benefit does this merger bring to our unit holders? We firmly believe that the proposed merger will be beneficial to unit holders. The need for a transformative merger, forming a larger, more diversified REIT, has become more compelling in today's changing real estate landscape. The merged entity will be underpinned by 3 key attributes, namely leadership, resilience, and growth, and will be in a better position to drive long-term value creation. The merger is also DPU accretive on a pro forma basis. Here, let me pass on to Kevin, who will illustrate or elaborate on some of the points that I mentioned earlier in my presentation. Kevin, shall I pass to you?
Thank you, Tony. So we're looking to create a bigger, better, stronger platform that's more efficient and more resilient for the future. So on leadership, CICT will have a strong and leading platform. Individually, CMT and CCT are leaders in their respective sectors and have the best-in-class retail and office portfolios with proven track records of portfolio performance and value creation. CMT has a balanced portfolio of very well-located and connected downtown and suburban malls. CCT has the widest footprint and the largest portfolio of Grade A assets in the Singapore CBD. The combination of 2 platforms with a long history of partnership will create an even more robust and efficient platform that will be very well positioned to meet evolving challenges and capitalize on evolving trends and opportunities. CCT will be a dominant REIT. It will be the 2nd largest REIT in APAC and the largest REIT in Singapore. Its scale will attract greater visibility and increase the potential for higher trading liquidity, positive re-rating, and a more competitive cost of capital. This will allow CICT to be more competitive in Singapore and developed markets overseas to drive new opportunities for growth. CICT will have scale to tap on synergies. COVID-19 has highlighted the symbiotic relationship between office and retail assets, especially in our integrated developments where the interdependence of office and retail components has been even more evident. The merged entity will capitalize on cross-selling opportunities, enhancing our digital platforms to deliver to and extract value from our enlarged customer base, optimizing costs through economies of scale, and eliminating frictional costs that exist between separate platforms. CICT will have a more resilient platform, the importance of which has been emphasized by COVID-19. The combined size, balance, and diversification by value and NPI across office, retail, and integrated commercial assets will result in a more stable and resilient platform that provides a hedge against market volatility. This improves the ability of the merged entity to compete through cycles. CICT's tenant mix will be well diversified across trade sectors. The top 10 tenants of the merged entity will account for 20.6% of monthly gross rental income, compared to 38% for CCT and 22% for CMT. The reduced asset concentration risks will also reduce earnings vulnerability and make the platform more resilient. Comparing the NPI contribution from the top 5 assets of the merged entity versus that of CMT and CCT, for CMT, it reduces from 50% to 43%, and for CCT, it reduces from 82% to 43%. Resilience increases the merged entity's flexibility to undertake redevelopments and asset enhancements, because the financial impact of embarking on such projects is reduced. This will translate to stronger value creation in the longer term, while supporting stable distributions in the near term. CICT will be well positioned to capitalize on future real estate trends to drive growth. Shifting occupier and shopper preferences, and a growing focus of urban planners on rejuvenation and intensification of land use are driving the market towards integrated retail and office offerings. This reinforces the rationale for CMT and CCT to converge, capitalize on these trends, and future-proof our assets. Growth will come from capitalizing on our combined domain expertise. CMT and CCT each have proven track records of pushing boundaries, repositioning our portfolios, and staying abreast of evolving real estate trends. Projects such as Funan and Capital Spring exemplify this. We will continue to leverage on this expertise to drive office and retail investments, and increasingly integrated commercial developments. The merged platform will have an extensive island-wide footprint of strategically located assets in identified growth clusters in Singapore. This presents opportunities to extract value from assets located in these clusters. Growth can be derived from the optionality and flexibility to undertake larger developments within the portfolio to drive future income streams. Both CMT and CCT have enjoyed uplifts in income when new developments come on stream. Capital Green is a good prime example. The merged entity will have a significant development headroom advantage of 5.8 billion Sing dollars, unmatched by any Singapore REIT. Growth will also come from having more options to invest. The merged entity will be predominantly Singapore-focused and with up to 20% in developed markets. So with an enlarged 23 billion Sing dollar investment portfolio that is only 4% invested overseas, we have the capacity to hunt for accretive acquisitions across developed markets. So aside from leadership, resilience, and growth, the transaction is also DPU accretive on a pro forma basis, including first half 2020 that was impacted by COVID-19, the pro forma DPU accretion for the last 12 months till June 2020 is 4.1% for CMT unit holders and 7.6% for CCT unit holders. So in summary, we are looking to build a stronger and more efficient platform for the future. We will be predominantly Singapore-focused with up to 20% in developed countries. We will focus on retail, office, and integrated commercial developments. We will create value through organic growth, AEIs and redevelopments, proactive acquisitions and portfolio reconstitution, and of course, prudent cost and capital management. These will be anchored by continued strong ESG commitment that both CMT and CCT exemplify. So I'll hand this presentation over to Tony, who will take us through some further details about the merger.
Thank you, Kevin. So before we end this presentation, let me highlight some key dates to note. All unit holders meeting will be held by way of electronic means on the 29th September. CMT will hold its EGM at 10:30 a.m., while CCT will hold its EGM and trust scheme meeting from 2 p.m. The last date to lodge your proxy forms for both meetings is 27 September. And the expected effective date is 21st October, and we expect to complete the merger by 30th November if we get a vote from our unit holders. So there'll be 3 resolutions to be put forth to CMT unit holders for voting. For CCT unit holders, approval is sought for 2 resolutions. Please give your voting instructions via the respective proxy forms, which has been dispatched to unit holder this morning. You may also obtain a copy of the forms via the SGX website and respective entities' website. So we have come to the end of our presentation. Thank you for your attention. Kevin and I are open for questions. Thank you.
Thank you, Tony and Kevin, for the joint presentation. My name is Mei Ping from CCT Investor Relations and your moderator for today's question and answer session. We also have with us here in this room Ms. Cindy Chu, CFO of CMT, and Ms. Ann Chua, CFO of CCT, for the Q&A session. Before we start, please be reminded that you can ask questions by clicking on the Ask Question tab at the bottom right-hand side of the screen and typing in your question. Now, we do have some questions via the webcast, and a few of them is about the timing of this merger. Let me try and ask the questions all together. Why did you previously halt the transaction, and why are you proceeding with the merger now? Tony, would you like to address the question first, followed by Kevin?
Okay, thanks, Mei Ping. I think first of all, I think we need to clarify. There's no point in time that we actually halt the EGM. As you probably know, COVID-19 is an unprecedented event and hit us hard. And follow on with the circuit breaker, both CMT and CCT at that point in time thought that we want to focus our immediate resource to support our tenants during that period of time operating under difficult circumstances. We also want to take the opportunity to allow a period of time so that we can present the potential financial impact, which was announced in our second quarter result, to unit holder, so that unit holder can make a better informed decision in the respective unit holder meetings. So it's under this context that we decided to delay the EGM. And bear in mind, we actually announced in January that we had earlier anticipated EGM to be held in May, but given that circumstances, it was not possible to do it in May. Yeah.
Kevin, would you like to?
So, this, in relation to the timing of this transaction, First of all, we've always established that this is a strategic merger of equals. And the whole idea is to create a bigger, better, stronger, more efficient platform. Right? As far as the scheme consideration is concerned, it reflects a market-to-market transaction. And this has taken into consideration various things, including the prevailing and historical price of CMT and CCT, and also balancing the interests of CMT and CCT unit holders, and also the merged entity going forward. So taking all this into consideration, we've tracked the trading of CMT and CCT units, and they've been trading in tandem. The merger is DPU accretive. So in light of all this, we believe that the transaction is fair, and as such, it's a good time to embark and announce our EGM on the 29th of September.
Thank you, Tony and Kevin. We also have a couple of questions from the media. So I'll start off with a question from Natasha from Channel News Asia. Her question is, how has COVID affected the outlook for the REIT sector, and how is the business looking to pivot? Maybe we can start with Tony first, followed by Kevin.
So COVID-19, like what we have presented, certainly has been created fairly across the sector, in the real estate space, to a different degree of impact. Specific for retail, you probably observe CMT. We have actually been very proactively managing our business even pre-COVID-19 days. Whether the overall trend of centralization or decentralization of retail space, the rapid development of the infrastructure in Singapore, which actually has an impact on how consumers shop because their travel pattern may change. So all this actually has been something of a norm, I'll say, for the retail space, and we have been evolving along the way. So with COVID-19 coming in, obviously we would have take that potential impact to the business, and slowly shift some of the assets potentially, like what we elaborated. The whole idea of the merger is to get a more diversified base, potentially moving into integrated development. At the same time, the retail business is also pivoting towards a little bit more into the digital space, where in June this year, with CapitaLand's 2 new digital platforms, it came right smack in the can say the whole landscape where it becomes quite complementary now. The whole omni-channel distribution model for a retail business become even more relevant. So that's an area that we're moving into, from a retail's perspective. Maybe I'll pass on to Kevin. Yeah.
I think what has happened, as we've seen over the years, is that the landscape for real estate has been evolving. And this merger of CMT and CCT is really a proactive response to that. And as Tony talked about, evolution of and changes in the retail space, I think the office space has also been evolving. And of course, of late, people have been talking about more flexible demand for office space. I think what COVID-19 has done is actually not change this evolving trends. In fact, we believe that it has likely accelerated these trends. So as such, I think what we are proposing today was valid pre-COVID and is still valid today. What you talked about is creating a bigger, better, stronger, more efficient and more resilient platform, embodying attributes of leadership, resilience, and having the ability to capture and capitalize on growth. I think this is what we're striving for. We are trying to create a platform that can address uncertainties that we are facing today. The COVID-19 situation is fluid. We don't know when we will get totally ahead of it, and when the situation will totally subside. But we're certainly making sure that we have a platform that's ready to address the uncertainties and also capitalize on opportunities that may present themselves in the future.
Okay, there is another question from Ferris of Bloomberg. The question is more specifically on the retail market. I think because given that the pandemic has affected the retail badly, I mean, are we looking to change the content of the malls? If so, how? And I mean, he or she also gave the example of will we be converting space to other users. So, Tony, you may want to address this.
Sure. So thanks for the question. It's very interesting because just like what I mentioned, retail landscape has always been evolving, pre or post. Post-COVID, obviously, there will be a little bit more a certain kind of dynamic. But even pre-COVID, I think we have already been facing that kind of landscape, ever-changing evolution in the retail space. So let me just put forth, this is actually not a new phenomenon that retail real estate is facing. So we have been going through that kind of evolution. With COVID-19 coming in, obviously there's a little bit of dynamic. Like Kevin mentioned, how that will eventually pan out is open questions. We, in the meantime, are trying to get more our retailer onto the platform so that it opens up opportunity for tenant to capture new business area. As you probably know, one of the key digital platform, CapitaLand program, is one of the leading digital platform in the retail market with more than 1 million members. So this more than 1 million members present an immediate potential business for our retailer in the mall. So we are moving towards that. Hopefully, over time, we look at it holistically as a business, whether it's the virtual space or the physical space. But we are able to present a more complete offering to our retailers. So I think that's probably one of the potential outcome you may end up with. The other thing we talk about from a real estate use perspective, and we mentioned even pre-COVID, there's already a very visible trend moving towards a mixed-use precinct or integrated development. So we'll try to seize that opportunity as it comes along. As it laid out in also URA master plan, there are already identified growth cluster, and within which our combined basis 24 property, we are in a good position to look at opportunity that come along the way. Yeah.
Okay, thank you, Tony. I think along the same line about the retail and office sector, the next question is from Joy of HSBC. Could you give us a quick update on the recovery of tenant sales for CMT and also on the percentage of workforce that has returned to the office so far? Maybe we start with the office now. Kevin?
So I think many of us are dying to come back to the office to work. I am, certainly for myself. And when you speak to my friends and my colleagues, most of them are looking forward to come back to work because it's a more comfortable environment. It's a place where they can have camaraderie of their teammates and clearly have a more pleasant environment to work in. In Singapore, at least for our CCT portfolio, we've seen about 24% of our office community come back to work. But I think this needs to be taken in context of the fact that, by and large, the Singapore government is still guiding companies to make telecommuting the default mode of work, meaning to say not all people can come back to work even though they may want to. We are certainly looking forward to the situation to improve and restrictions to ease so that more of our office community can come back to our offices.
So for retail, I think we've seen quite encouraging sign of shopper coming back, confidence coming back and visiting shopping malls. And probably all you out there may have experienced in your own way. Certainly there's a need. There's an innate need for human to socialize, to interact, to dine. So we look at the shopper traffic that presented. The trend looks very encouraging. Some of the malls are already recovering up to 70-80% of our shopper traffic compared to pre-COVID. Albeit downtown malls slightly less, but gradually, like Kevin saying, more and more people started to come back to the office. and more people started to visit downtown more over the weekend. We are seeing very encouraging signs as well. And the gap is really narrowing between what you see in suburban and downtown. Taken as a whole, that we presented is about 58%, with the better ones at around 70-80%. So even downtown, we see Plaza Singapore, Atrium are having a very strong recovery from a shopper traffic perspective. And putting in context, this is in an environment where our border is still somewhat closed, right? Although there are signs that gradually the country seems to be opening up. So while we think that eventually the cross-border travel will resume, I think downtown mall will definitely benefit when this happens. Yeah. So overall, it's been very encouraging. Yes.
Yeah. Thank you, Tony and Kevin, for giving us a perspective of what's current. The next question we have is from DBS, Derek. His question is more about valuation. I think given that in first half 2020, I think for both REITs, they've seen a drop in the valuation of about 1.5% to about close to 3%. So what is management view about valuations in the medium term, post-COVID? And potentially, how long will valuations rise back to pre-COVID level? Maybe you can start with office first, followed by retail. Yeah.
Derek, thank you for that question. We will not comment on projections because that's really the job of our independent valuers to assess what down the road what the value is. We did our valuation as of the 30th of June, as you pointed out. This was in light of this merger, and we wanted to provide some flavor to our unit holders and investors on the impact of COVID on our portfolio. We will be doing evaluation at the end of the year. I think overall, if you talk about valuations, the factors and considerations that we have seen in the office sector that we saw in our 30th of June valuation is that it was largely impacted by assumptions of rental growth, changes in rental growth assumptions, and market rents. We did not see any change in our cap rates. And if we were to look at where office investments have been reported at, I think we are hopeful that this can the cap rates of investment properties will hold.
Quite similar in line with what Kevin mentioned, that the value obviously will take into consideration when they do the valuation in December at that prevailing market condition. So I don't think it's not for us to comment how that will look like. But more importantly, I think it's about the value creation going forward. And what we put forth to our unit holder is that on a combined basis, I think we are in a better shape. And another thing to point to note is that, and it was one of the strong propositions we put forth to unit holder, is this Singapore core team. And Singapore real estate generally is still very well in demand across the world. So we think that in the long run, the value we were able to create more value for the unit holders. With a bigger platform, there will be more resilience. There will be more opportunity to look at growth. And also, at the same time, we will be the largest REIT. And in today's market, liquidity begets liquidity. And we think that we will be in a better cost of capital situation. Yeah.
Okay. Thank you. The next question we have is regarding about the retained distribution. So there are a couple of questions, but I think largely they're asking about that. I think there were retained distribution in the first half. So will the rest of this will this retained distribution be released before the completion of the merger or by 30th November? Yeah. So Tony, would you like to?
So I think like in the CMT's result announcement, I did mention that we are releasing 1/3 of our retained distribution. Bear in mind that we have actually came out from a circuit breaker. We'll continue to assess the situation, but the underlying principle is that we will not want to withhold any unnecessary retained earning, if possible. So we'll continue to assess in the months ahead the situation, operational situation on the ground.
In the case of CCT, as you know, the amount of distribution that we retained in the first quarter was distributed in the second quarter. I think unit holders of both CMT and CCT can bear in mind that at the end of the day, all permitted distributions will be there'll be a cleanup as part of this merger, and appropriate distributions accruing to each would be distributed accordingly.
Okay, thank you. There is a specific question from I think it's more CCT unit holder. I think it's so it's more about the I think given the distribution from the retail side, it's a bit more unreliable. So it's, will CCT unit holders be affected after merger?
When we presented early on, we shared that this transaction will be DPU accretive. In the case of CCT unit holders, we're looking at a 7.6% accretion. I think it's important for unit holders on either side, CMT and CCT, to look at the entirety of this deal and the merits and the benefits that this deal will bring. We are ultimately looking to create a stronger platform that has got leadership, resilience, and the opportunities to drive growth. At the end of the day, with this stronger platform, I think we'll be in a much better position to create and deliver value for both CMT and CCT unit holders today. So for CCT unit holders, my point to us is all, I'm also clearly a CCT unit holder. I certainly look at this deal as a positive transaction. It's something that will create value for myself and for all of us going forward.
Thank you. This next question is also a combination of a few questions. It's more regarding about the opportunities I think that the merged entity will likely look at. So maybe I will try to put it together. I think one of it is asking from Maysian that do we foresee that some of our existing properties will be converted to integrated development? I think this is again about the plans. And another question from Faris is about how will we shape how does what's happening now to the retail and office shape our consideration when it comes to future acquisition of such assets? And then there was another question about the strategy of the merged entity. So I think I'm just putting this all together. So Tony, perhaps you'd like to start, and then Kevin can also add.
Sure. So I'll answer holistically, right? I think at the end, if you look at if the merger were to proceed and you get your vote from unit holders, we immediately on day one will have exposure to 3 different asset classes as presented earlier. So we have that flexibility to look at opportunity, and you obviously know real estate move in different cycle. So we will assess the situation according to the market cycle and opportunity that surface to us. Because of that ability to look at the 3 different sector real estate space, we definitely have more ability to look at opportunity. Yeah.
As far as adding on to what Tony has said, it's the optionality and the flexibility to create value from multiple channels. Yeah? So as a platform, we've also shared we will be predominantly Singapore focused with up to 20% overseas. Our immediate focus clearly is on Singapore. We've shared that we have a very, very wide footprint of assets across Singapore, and quite a number of these are located in identified growth clusters. These are opportunities where we can consider and think about redevelopments for that would address the trend towards the demand for a more live, work, play environment, and then such that would mean possibly more integrated developments. So certainly I think there are opportunities out there that we can capitalize on. Yeah.
Okay. Now we switch the focus a bit. I think it's more of a clarification. It's regarding the management fee. So the question is about Is it still correct that the management fees for CCT's office building portfolio will double as they are going to be increased by from today, and then when for any new acquisition, because it will be aligned to CMT's fee structure? Yeah.
Just to correct that, the management fee for existing CMT units or CMT assets would be based on the existing CMT structure, and for existing CCT assets based on existing CCT structure. It's only when we are looking at maybe future acquisitions where the management fee would be based on the CMT structure. So it's not true that our management fee would double for CCT, the CCT platform.
Okay. Also related to fee, why the decision to waive 100% of the acquisition fee now? So, Tony, would you like to answer?
Yeah. Well, just like what I presented earlier, recognizing that COVID-19 is really unprecedented, we wanted to waive this on a 100% basis to show our commitment to the merger, and also to align all our interests, the manager's interest and the unit holder interest, respectively, for CCT, CMT unit holders. I think our interests are really aligned in this deal. Yeah. So that's really the key reason.
Okay. The other question we have here is regarding I think it's more on the scheme consideration. Okay, there are a few topics here, but I'll ask about the scheme consideration first. I think the question from Derek from Macquarie is that the office sector is doing better than retail. Why is the exchange ratio not tweaked in favor of CCT unit holders?
So if you look at the scheme consideration, it's really a reflection of a market-to-market arrangement of valuation. Yeah? And as Tony shared, our scheme consideration is basically 0.72 for every CCT unit. You will receive 0.72 CMT units and a cash consideration of 25.9 cents. Throughout all this time, when we first announced our deal on 22nd of January till today, the market price of CMT and CCT units have largely traded in tandem. So as such, when we look at this and we look at the other considerations of this scheme consideration, how we arrived at it, we also are balancing off the interests of both CMT and CCT unit holders, and also that of the merged entity going forward. We think the overall metrics of this scheme consideration remain fair because it reflects the market condition. If you asked us today, I mean, your question today is whether we'll make why we did not change, and the scheme consideration. Essentially that's it. That it reflects the market as what we are seeing today.
So this is maybe just an add on, Kevin. I mean, we look at it holistically. The transaction, of course, Kevin already explained that actually the unit price between CMT and CCT actually more or less traded in tandem since January. They are hovering around on a net basis 0.72 to 0.74 exchange ratio. So it's not deviated too much. So, but beyond the immediate the financial aspect, the driver behind the whole merger is still very valid. We're talking about creating a platform that's more efficient going forward, having a diversified base and large base, creating the resilience, opening up more opportunity, creating the leadership position in the market. I think all this put together is really the whole thing that we considered holistically. Yeah. So overall, we feel that this is the optimal outcome for both sets of unit holders. Yeah.
Okay. We're back to retail questions. I think just now, Tony, you've shared about the shopper traffic and all. So the question now from Brendan of Citi, as well as Mervyn from JP, is asking about tenant sales. So he's asking where are tenant sales trending for the month of August versus pre-COVID, and what is our outlook for the rest of the year? Tony?
Okay, so August, we're still tracking. Today we are only in early part of September. We are still doing the books. But post-circuit breaker, like what I've explained earlier, actually we've seen quite encouraging sign. The shopper traffic has came out. The July sale has been also trending in a positive, I say, very encouraging way. So we hope that momentum will continue. Certainly from August shopper traffic perspective, it is very encouraging. We are still waiting for the final number. Yeah.
Okay. And then another question would be about the development headroom. How soon could we expect to see the merged entity tapping on the greater development headroom? And what are some of the areas or potential assets that could fall into this plan? This is from Brandon of Citi.
Shall I take?
Yes, Tony, sorry.
So if we were to proceed with the merger, obviously one of the first things we would do is to look at the enlarged portfolio, and assess how we want to potentially look at the portfolio constitution. It may involve some portfolio reconstitution, concurrently assess the opportunity that we make available to us. Some of the opportunity that we mentioned in our presentation, identified growth clusters, certainly those are the areas that we'll pay closer attention to. Exactly which one will surface eventually is still early days, but certainly we'll be exploring all these areas that we are talking about, yes.
I think a related question is from Derek from Macquarie. He's also asking, would CICT develop or acquire integrated developments overseas? I mean, not just now we're talking about Singapore. I mean, his asked questions about overseas, and also knowing that the merged entity has some exposure in Germany. Yeah. Yeah. Kevin, you want to?
If you look at our portfolio today of 24 assets, 96% of our portfolio value is in Singapore and 4% overseas. I think at the end of the day, when we look at any acquisitions, be it retail, office, or integrated commercial developments, it has to be done in perspective, considering and assessing the various options that we have and the risk-adjusted returns that each investment opportunity may present. Right? So I think at the end of the day, we'll have to look at each opportunity as it's presented themselves. Yeah? Yep. As we shared, we're looking at up to 20% overseas with the predominance of our portfolio in Singapore.
Okay,
yep.
Thank you.
So just to add on, I think
yes.
We thought we should also re-emphasize the core is still going to be Singapore. So the Singapore core is going to be the strong focus with the flexibility at looking at overseas up to 20%. So give us that flexibility and across 3 asset classes. Yeah.
Okay. The last question we have on the webcast is about management change, whether you can give any comment. Tony?
I think it's premature to talk about management changes. Certainly, we want to put our focus on getting through the finishing line, and once we go over, I think we'll definitely update the market in due course how that management composition will look like. Yeah.
I think we mustn't forget that this is a large transaction, and the whole premise of coming together really is to leverage off the combined domain expertise of the CMT and the CCT platform. And certainly as a result of that, I think it's incumbent on us to bring to bear the expertise from both sides of the aisle. Yeah, right? So in due course, we'll be sharing more information about the management team going forward.
Okay. And rest assured, you'll be well resourced to run the combined platform. Yeah.
Thank you, Tony and Kevin. We have now reached the end of our question and answer session today. In any case, if you have other questions, please feel free to reach out to us. And both REIT teams will also be going out to reach out to our unit holders to address any questions or concerns that they may have. Thank you for joining us on this webcast today, and stay safe and well. Thank you.
Thank you very much.
Thank you.